This is a depreciating asset. It loses its value the minute you drive it off the lot. If you are underwater on your car, meaning you owe more than it's worth, I want you to hear this first. You are not bad with money. You are not alone, and this is a fixable problem. Negative equity is incredibly common right now due to a whole range of factors: high car prices, long loans, and high interest rates. But today I am going to walk you through exactly how to get out from under an underwater car, step by step, without panic, shame, and without wrecking your finances. Thank you for joining me here today at Sisters for Financial Independence. My name is Catherine Agupjan. I am a personal finance educator and an older millennial. And for a lot of videos here at Sisters for Fi, I am the bearer of bad news. I am the older sister who tells you to downgrade, stop buying stuff, and start saving your money. And I will be the one to tell you to start facing the music on your student loans. And today's video is not going to be any different. We are going to tackle your car loan so that you can finally be free of it. Growing up, I didn't have anyone to turn to when it came to money. I navigated the corporate world on my own: corporate benefits, student loans, getting a car. So I hope that some of the videos here at Sisters for Fi can help you. When you subscribe to Sisters for Fi, you will get notifications on new videos, but you'll also see some of our old videos and they can help you with your money. Because trust me, you will want more money in the future because it gives you options and freedom. First off, let's take a deep breath. Being upside down is a math problem, not a character flaw. And being underwater on your car means you owe more than what the car is worth on the market. And for many who have just bought their car, this is normal and nothing to worry about. For those who have had their car in a while, this could become a problem as it signals many things. So first, I want us to understand the relationship between a car value and your car loan. This can help us understand why there is a gap. So let's get to a chart. Thank you to carbuyingtips.com for this beautiful chart. Now here in this chart, let's look at our blue line first. This is your car value. You'll see that the value of this car declines over time. This is normal depreciation. Some cars depreciate more than others. So it's important that you look at the make and model of your car to see how much it depreciates over time. For example, some Hondas and Toyotas do not depreciate as quickly as other cars, meaning they hold their value over many years. So it might be worth considering getting those kinds of cars instead of a car that depreciates quickly. Now let's look at the red line. This is how much you owe, or in this case, your car loan. You'll notice there's a difference here. So this might be that you have a balance of $35,000, but the value of your car is only $30,000. So there's a difference there of $5,000. Now over time, if you are not careful with this, it means that this could grow larger, or you can spend many years paying it off and finally get a break-even point where your car loan and your car value is even. For this example, we are looking at a break-even point of 6 years. Now, how does a car loan like this happen? So most often this happens because maybe you are not putting a down payment. You could have a high interest rate, so you're borrowing higher rates and borrowing more than the value of the car. You could have rolled a negative equity, so you could have had another car, owed money on that, and rolled that debt onto here. So this is what we don't want. We don't want this large gap. We want to move this red line, our car loan, a little bit closer to the car value. And in order to do that, we will need to make sure we look at the math. We do have to make some calculations to lessen this gap so this upside down or negative value isn't so high, and we can finally get to the break-even point. Now, I also want to just show you something here. As we pay off our car, we get to the break-even point. So our car and our car loan are the same. But notice over time, as you continue to pay your loans, the car value starts getting steady. And again, this is an important gap for you to look at. Many people will automatically trade in their car for a new one because their car is now 7 years old. But if your car runs great, or if you know you can get a few more years out of your car, this gap here is the gap that will get you to financial freedom. This is the time where you are going to save the car payment. This is the time where you are going to be putting that money away while still driving a good, useful, reliable, and safe car, but not paying for it. Now, at some point, you might have a graph for maintenance, but if you are diligent and careful, you can reduce that maintenance value and make sure that you are using this gap to save yourself money instead of continuously having a car loan and car payments for the rest of your life. Now, most people don't end up underwater because of one bad choice. Unfortunately, it's a combination of many things. Let's review them again so that we know what to avoid in the future. The first one is small or no down payment. The second is the long loan terms. 72 to 84 months is now common, but it also means you are now paying more in interest, which is good for your monthly payments, but overall you will pay more for your car. The third is the high interest rates. Now, we are still in a high rate environment, and even at a good credit score, car interest rates are ranging between 6 to 7%, which means more of your money is going towards interest instead of the loan payoff. The next common thing that many people do is roll old car debt into a new loan. This is getting to be a very common thing, with around 20% of car buyers rolling in negative equity. This basically means you are still paying for your old car, you're just putting it in a new loan. It means you're paying for something that no longer exists. Now, I know the need to upgrade is strong, and oftentimes if you don't do the math or don't pay attention, you could be in this boat, and it puts you in a cycle of bad car debt. And lastly, normal depreciation. Cars lose value. Some make and models lose value more quickly, so you do need to review the kinds of cars you get. In the end, an underwater car does not eliminate your options. It might be reduced a little bit, but know that you still have options. There's no magic bullet here, so we are going to go through a few ways you can solve this problem. Step 1, don't make it worse. Now, before we talk about actually getting out, we need to make sure we are not making this car debt worse. So here are some things you should not be doing. Don't trade the car in and roll negative equity into a new loan. I will shout this from the rooftops, and I will tell you this multiple times in this video. Don't do that. That is not a good plan. Don't refinance blindly into a longer term loan. You will pay more in interest, and you will pay more for the car. Don't panic sell without a plan. You need a plan in place so that you can make sure you address all of the reasons why you're in the situation in the first place. Step 2 is to know your numbers. You can't fix what you haven't measured, and you are going to need 3 numbers. The first one is your payoff amount. Don't look at your monthly statement, but actually log on or call your bank and get your 10-day payoff amount. The second number you're going to need is your real world value. Use Kelley Blue Book or Edmunds, and also try to get a real cash offer from places like CarMax or an online buyer. You want to see the true value of your car. And the third number you are going to need is the gap, which is your payoff amount minus your real cash offer. That's your negative equity, that's the underwater amount, and the amount that you will likely need to come up to even out your loan. And this is going to be where clarity replaces anxiety. You need to know the numbers, because once you know the gap, you can choose the path forward. There's no magic solution here, but there are multiple ways you can get your car back in the green. And no matter which path you choose, it is going to get uncomfortable, and you do need to do some work, whether it's researching for new interest rates, researching the best option for you. You must put in the time to figure out the best plan to get out of this. I also want to emphasize something. Car loan debt does not exist in a vacuum. For a lot of Americans, many focus on paying off their car payments first because they have a fear of getting that car repossessed. So this means you might be on time with your car payment, but not on time with other things like a student loan or a credit card debt. The car is the most visible signs of success and the one thing that most Americans fear of losing. So you do have to be honest with yourself about your relationship with your car and how you can fix it. These feelings are going to be uncomfortable. You're going to need to do some work that will take time, take mental energy, but it will be worth it. Step 3 is to choose your exit path. The good news is that you do have options. You just have to figure out which one will work for you. The first thing that you are going to do is try to get an instant win. Look at your sales contract to see if you bought certain things like an extended warranty, tire wheel protection, etc. See if those things are absolutely necessary or if you can cancel those. Contact the dealership's accounting department, not the salesperson, and ask for a prorated refund. That refund won't come to you as a check. It goes directly to your loan balance. So you can reduce your loan amount by a significant amount if you cancel some of these extra add-ons. And that can be an instant and quick win for you. So review your sales contract, check for add-ons, and see what's possible to cancel. By the way, this same tip is what I will tell you if you have credit card debt as well. Return the stuff you haven't used and let that credit back to your credit card to lower your balance instantly. There's no shame in returning something you haven't used. Now, quick reminder here too that if gap insurance was something you signed up for, you likely will need to keep that. It just ensures that there is funds available should something happen to your car. It's what pays for the gap between your car loan and the car value. From there, you will have 3 big options. The first one is you keep the car and pay it off. Requires hard work, requires you'll do a lot of things to ensure you stay on your payments. And the second option is to sell the car and cover the gap. This also requires work. This requires you to find a way to cover the gap and get another car. And the last option is to refinance your car, which requires you to search for a lender that has a better rate than you have right now. Let's look at all of these options so you know exactly what you'll need to do for each one. Option 1 is to keep the car and pay it off. Now, if you love the car and can afford the payment, but just don't like that it's underwater, your goal is to catch up to the car's value. If the car is reliable, safe, and meets your needs, this is often the smartest move. Now, here are a few tips to help you with this. Tip 1 is to make principal-only payments. Even an extra $100 a month makes a dent. And for every dollar you send into the bank, make sure you mark it apply to principal, as it allows you to get your debt down much faster before the car loses value. Tip 2 is to try the bi-weekly payment hack. Pay half your payment every 2 weeks. You'll end up making 13 payments instead of 12, and you likely won't even notice it, and then you can get your debt much faster. Tip 3 is to use your tax refund. If it's tax season, use that refund to bridge the equity gap. It's the fastest way to pay down and get yourself out of a bad loan. But make sure you have a plan in place. Oftentimes, we see the tax refund as free money and we spend it accordingly. So if you are going to get a tax refund, make sure you earmark a portion of it for this car loan. And tip number 4, get that side income. Side hustle, work overtime, and so forth. And again, earmark that money to be paid for your car loan. Option number 2 is to sell the car and cover the gap. Now, if that $1,000 payment is killing you and you need out now from this car, you can try this method. You will need to sell your car privately. Better to do it privately because you can get $2,000 or $4,000 more selling to a person than trading it into a dealer. And you'll also need to cover the gap. So if you sell your car for $32,000, but you still owe $38,000, you need to find $6,000 to pay off that loan and get the title from the bank. Now, for that $6,000, you have a few options. You can use your personal savings to do this, or you can go to a credit union and ask for a personal loan to cover that $6,000 or whatever that gap may be. Here's the big thing. You have to do your research. You'll have to call up a bunch of credit unions. You'll have to see what's available so you can get the best rate possible. Yes, you will take on a new loan to get out of your old loan. But the logic here is that the new loan that you're getting will likely be at a lower rate. You'll only be taking out a loan for $6,000, much smaller than the bigger car loan that you have. So you are trading in loans in this case, but you still need to be diligent. You want to make sure you're shopping for the best possible loan available out there so that you save money there too. With this method, you get rid of that massive monthly payment and your depreciating asset all in one move. But this does put you in a predicament, because if you need that car and you've turned it in or sold it somewhere else, you will need a car. So you also need to figure out how you can buy a car that's safe, reliable, at a lower price or much cheaper. You might need to downgrade in this case, or make do without a car for a few months until you save up enough to buy your car in cash, or at least at minimal financing. Turning in your car absolutely hurts, and downgrading can hurt your ego, but this is going to be necessary if you want a future that doesn't have all the stress and anxiety of having that $1,000 monthly payment. Option 3 is to refinance the car. This is normally good if you have high rates right now. Review your credit score and see if it has improved, and if the rate environment has changed, it can be smart to refinance your car loan. You'll need to look at banks, credit unions, and online lenders for the best rate possible. You'll need to do some research and find yourself the best option. Do not go with the first one. Negotiate and try to pit each bank against each other so you can get the best loan terms possible. Now, when you do apply for refinancing, what will happen is that the new bank will pay your old loan, and now you will have a new loan with your new bank. In this scenario, you want to make sure that you either keep the loan terms the same, just a lower rate. Now, the point of refinancing is to lower your total cost. So if you're only getting a lower monthly payment, that is not going to be a win, as likely they've extended your loan and you still owe as much. The reality is that banks won't usually refinance a car that's too far underwater, so you'll need to check your numbers. And of course, consider if there are prepayment penalties on your current loan. Remember that we want to save money, not add on to it. So make sure review all the fine print when it comes to your car loan, any prepayment penalties that you'll have to pay, any type of documentation fees, extras that you'll pay with the new loan. You want to make sure you account for all of those costs. And another reminder, do not roll your negative equity into a new car. The dealers will make this easy. Oh, sure, we can roll that $6,000 into a new SUV. You can drive out in a fancy new car, but your payments will be greater. You'll pay more in the end. And I know this feels easy. You just have to show up to the dealer, trade in your old car, and it feels like that debt is disappearing. But it is not. It's being added, and it means you are going to be paying longer for that car. And that stress and anxiety is something you do not want. I want to add a partnership check here, and it's important for families. If you are married or partnered up, this is not something you carry alone. Negative equity affects your family's cash flow, your stress, your parenting, and your future goals. This is a household decision, not just a driver decision. So make sure you sit down together and figure out the best way to move forward so that you don't have a lot of resentment and a lot of anxiety and stress later on when those car payments hit your wallet. It can be hard to think about getting on the other side of this, but you can and you will. And when you climb out from your underwater car debt, it means you will have fewer arguments at home, less mental anxiety, more flexibility for your family, and a sense of control with your money again. You stop dreading your monthly payments and you stop feeling trapped. And that means you'll have more choices and freedom in the end. Here's the truth. Getting out of negative equity isn't about perfection. It's about stopping the cycle. And once you do, you're never going to look at car payments the same way again. If your car is underwater right now, like and save this video. And if someone you love is stuck in bad car debt, share this video with them. And if you want help avoiding this next time, I'm going to recommend you watch the bad car math video next. And if you are tackling credit card debt along with this whole playlist can help you. Thank you for tuning in, and I will see you in the next video. Bye!